Hi everyone.
Welcome.
Welcome to the 2026 annual Coase Lecture. Now, law and economics is now an international movement that has conferences and events around the world with Asian Law and Economic Society, Latin American Law and Economic Society, European Law and Economic Society, etc. But really, the law and economics movement can really be attributed to starting here at our law school in 1946, if you have to pick a date, at the start of the free market project. So then Aaron Director at this law school started a project of trying to understand how economic principles should shape the way that we think about law and regulation. And this movement that started here at this law school by starting workshops and then journals like the Journal of Law and Economics and later the Journal of Legal Studies produced a group of scholars that I think had an extremely outsized influence on this, not only the future of law and economics, but law more generally. So this includes Richard Posner, Frank Easterbrook, Cass Sunstein, Posner, a range of scholars that have had just profound influence changing the law. But one scholar among them, Ronald Coase, was part of that early movement, had hugely influential work on the problem of social cost, the theory of the firm, and developed the theory of transaction cost economics. And for this work in 1991 was awarded the Nobel Prize in Economics. And at the time, and still to this day, was the only law professor to be awarded a Nobel Prize in Economics. Following this, the next year, we started this tradition of the Coase Lecture, where Coase himself was the first lecturer. But each year since, we have a member of our faculty provide a lecture on some important themes in law and economics to try to share ideas and insights about how law and economics can change and shape the way that we view the law. So this year, for our annual edition of the Coase Lecture, we have our faculty member, Professor Vince Buccola, here to give the lecture. Vince is an alum and a graduate of our own law school. Following law school, he clerked for Judge Easterbrook, was a trial lawyer at Bartlett Beck, before coming here and becoming a Bigelow Fellow, where in a bit of a full circle moment, Vince and I were Bigelow Fellows together here at the law school. Professor Buccola then went on to Wharton School of Business at the University of Pennsylvania before coming back and joining the faculty 2 years ago. Vince is going to give us today's Coase Lecture on what's optimality in financial contracting. Please join me in welcoming Professor Buccola.
Okay, thanks Adam for that introduction. I started coming to the Coase Lecture as a 1L 20 years ago, and I think I've watched every one since, either on YouTube or live, and gotten a lot out of them, so it's an honor to be doing this. So my topic today is financial or investment contracts. So these are going to be deals in which one party, let's say an investor, agrees to give capital to another party, the company, for its use, building, growing, operating a business, and in exchange for some kind of claim on the company's future cash flows. More specifically, my topic is going to be the extent to which financial contracts are written so as to maximize the parties, that is the companies and the investors' expected joint surplus. All right, so what are the stakes? Let me level set here for a minute. There are two basic problems, I want to say, at the heart of all financial contracts. One is adverse selection. Company management, who are trying to raise capital, typically know more about their business's prospects than the potential investors do. And that asymmetry gives rise to a predictable investor anxiety. And why exactly are the people who know about this business offering me such a good deal on a piece of it? Which, if unaddressed, makes investment capital formation challenging. The other problem is moral hazard. Once an investor gives funds to the company, the interests of the people who are going to put the funds to work, let's call those the managers or the manager, are going to diverge from the interests of the investor. How exactly their interests will diverge depends on a bunch of variables beyond our scope today. But in general, the direction of travel is going to be ambiguous. Sometimes the manager will want to take bigger risks than the investor, other times smaller risks. And sometimes the manager wants to take the money and run to Vegas. Now, importantly though, the conflict can be subtle. A manager not wanting to fire, kind but unproductive employees is typically the bigger problem than his desire to put everything on the roulette wheel. In any case, Interests diverge because the future is, as the economic theorists like to say, non-contractable. At the time an investment is being made, we can't foresee and describe all possible futures that might come to be, much less specify what's going to happen in each one of them. So openness to the future is a bedrock property of the world on top of which corporate finance works. And that means that conflicting interests are bound to ripen into what the literature calls agency costs. Now, much of the meat of financial contracts is self-evidently about ameliorating adverse selection and especially moral hazard. Thus, in addition to sizing investments appropriately, contracts often give investors some combination of redemption rights, that is the ability to pull out capital under certain circumstances, veto powers, like the right to block a particular decision by a manager, or governance rights, as in like the ability to replace the manager. So the question for today is how well financial contracts manage what we can all see are inherent and insoluble problems. The conventional view from the law and economics wing of the faculty lounge is that contracts do this very well. Now, in previous versions of the remarks I'm giving here, I was going to offer a bunch of examples. Some reasonably well-received academic pieces that assume more or less explicitly that contracts, while imperfect, trade off the costs and benefits of capital lock-in exceedingly well. And the fun part of these examples was going to be that I wrote them. So I'm not just like caricaturing people like outside the house. But in the interest of time, I'm going to skip that exercise, and you'll just have to take my word for it. It's not that anyone thinks that all contracts are efficient. When parties don't have much at stake or have invested little in trying to understand the ways a transaction could go wrong, they can make a lot of mistakes. Economists are especially concerned when the parties are asymmetric in these regards. Hence, we have a whole field of law and then a whole restatement of the law devoted to consumer contracts. But none of those difficulties are apposite when it comes to the kinds of financial contracts I'm talking about. In the contracts I'm talking about, the parties on all sides have a lot at stake. They spend their waking hours mired in the build-up to and the aftermath of the financial transactions at issue, and they can and do pay for expensive, smart lawyers to counsel them. Okay, so I hope you've guessed by now that my aim today is going to be to suggest that the picture is wrong, that I and others have basically misconceived financial contracts. First, though, we need to understand why one would ever suppose that contract terms are even roughly value maximizing. And I'll start by saying that the answer is not empirical, at least not in the sense that like anyone has measured the degree to which actual terms tend to create surplus. That kind of empiricism is virtually impossible. Variation in contract terms isn't usually a matter of random assignment, which complicates causal inference. And even when you have plausibly at least a quasi-random assignment of terms, there's going to be a lot of noise. That is, there are lots of factors other than the term of interest that jointly determine the economic outcomes. So econometric proof is going to be really hard to come by. Instead, I think a belief in contracts that more or less maximize is well-founded only insofar as it turns on a more basic view about the mechanisms that produce contracts. I think there are basically two such mechanisms, design and selection, and I want to talk about each of them briefly. We'll start with design. So we're at Chicago, we're at the Coase Lecture, so I hope you saw this coming. The Coase theorem says that absent bargaining frictions, people will allocate their resources to the highest value use, irrespective of their baseline legal rights. The idea comes, of course, from Coase's 1960 paper, The Problem of Social Cost. As you'll recall, that paper, taken on its own terms, was focused mainly on two-party conflicts over the use of real property, the doctor and the confectioner, the rancher and the farmer, and so on. But as many at this law school and across the Midway quickly saw, there's no particular reason to limit the generality of Coase's irrelevance insight to those contexts. Crucially for our purposes, it holds equally for an investment contract. At baseline, the investor has a legal right to the present use of her money. just as we might imagine the confectioner has a baseline legal right to make noise. The question she faces is whether to reallocate her money to the company and on what terms. The Coase theorem says that absent bargaining frictions, she'll give it to the company if its managers can make better use of the money than she can on such terms and such conditions. Think about covenants, liens, voting power, veto rights, as the parties think will maximize the sum of their individual rewards. Now, one could doubt the applicability to financial contracting of the kind of low-cost bargaining environments that arguably describe neighborly conflicts over land use. You might think, for example, that neighbors are going to have an easier time hashing out the costs and benefits of putting up a fence than an entrepreneur and a prospective investor will have dickering over the size of a debt incurrence basket. And some investment deals are reasonably intimate, as when a company tries to raise funds from so-called friends and family. But capital markets transactions, the issuance of tradable loans, bonds, equities, and so forth, are struck in a one-to-many bargaining environment. The company on one side and many potential investors on the other. So that low-cost back and forth is a fantasy. Instead, the company selects the terms with some investor input, but more or less unilaterally. So you might think the Coasean framework just doesn't apply. But that would be too simplistic. Investors in a capital markets transaction don't negotiate, at least at first approximation, but they do bid. That is, they decide how much they're willing to pay for a contract that has the terms the company has imposed. And the investors are sharps. They're well counseled, they've seen a lot of deals, and they have high-powered incentives to earn risk-adjusted returns on their capital. The more favorable the terms are that are being offered to them, the more they should be willing to pay, which is to say the lower the company's cost of capital should be. Thus, the price mechanism forces the company's managers, who write the contract, to internalize the risks that the contract is going to impose on the investors, including the risks of the manager's own moral hazard. Even when there's no negotiation at all, then, the manager has an incentive to write terms that he thinks will maximize joint surplus. Okay, now let's talk about the other mechanism, selection. And I do mean to invoke here the evolutionary concept. The best way to grasp the significance of selection here, I think, if it's not already self-evident, is to consider a thought experiment posed some 75 years ago by the great Armin Elchin. Elchin wanted to investigate a question not far from today's topic. Do companies seek to maximize their profits? Neoclassical economic theory is built on the premise that they do, but why should they? Elchin offered that evolution could help to explain. To demonstrate, he posed a thought experiment. Suppose a market populated by an arbitrarily large number of firms. Suppose further that the firms, or let's say their managers, don't consciously seek to maximize profits. Each acts sort of randomly within a plausible set of functions. What happens? In the first instance, survival is all that counts. For a business, this means roughly that revenues have to exceed costs. And that's a function of relative rather than absolute performance. Maximization just doesn't enter into it. Or as Elchin put it, even in a world of stupid men, there would still be profits. Nevertheless, the process of selection over time will cull the firms that make the least efficient use of their resources. The firms that use their resources more efficiently can pay higher dividends, and thus attract cheaper capital and expand more, can offer better deals to customers and so win market share, can pay employees better and so recruit better talent, and so forth. The more efficient firms take over from the less. In equilibrium, only the realized profit maximizers survive, even without any conscious design. Okay, instead of maximize profits, we can swap in right value maximizing contracts and we'll get the same result. Okay, so those are the mechanisms, design and selection. And of course, they're complementary. We don't have to choose one. Companies and investors who are agreeing to a financial contract are trying to write efficient terms, and selection is causing those who succeed to increase market share. Okay, so then why then do I say that the terms we observe in actual markets are more than a hop, skip, and jump away from perfection? The answer is that the conditions under which design and selection should produce, if not ideal, then at least very good terms as a matter of theory, just don't hold. Now, don't get me wrong, terms are better than a random draw. They're much better than that. Incentives to design, especially, but also selection, put a floor on how bad terms could become. But I don't think we can actually say much more than that. So let's start with design. And I want to highlight 3 features of typical contracting environments that should, and I think do, warp the outputs. The first feature is going to be a principal-agent misalignment at the investment firm level. That is, divergence of interest between the people who pool their capital for investment and the people who actually invest it. To make this sort of conflict concrete, consider the situation of a collateralized loan obligation, or a CLO. A CLO is, in effect, a box designed to hold risky corporate loans and harvest the returns from them over 10 years or so. Investors contribute funds in exchange for one or another hierarchically differentiated claim on whatever the CLO manager has in the box. The most senior claims are supposed to be super safe, and they are. Then there are riskier and higher yielding notes. And finally, there's equity, which gets the residual left over after everyone is paid. The CLO manager, the person who decides which loans to buy, when to trade them, and so on, holds the equity. The problem is that the manager's equity position encourages him to create excessively risky portfolio. It's a species of a well-known dynamic. If the portfolio does well, the equity gets all the upside. But if the portfolio blows up, senior investors carry much of the bag. In the CLO context, this translates to the CLO manager wanting to hold loans made to more leveraged or otherwise riskier companies because yields on those loans are going to be higher. Now, the CLO investors aren't stupid. They understand the incentives, and CLO managers understand that they understand. So together, they try to mitigate their anticipated conflict. But the result is that the terms of underlying corporate loans, which are bought and sold, themselves should depart from value maximization contrary to the design thesis. 2 channels I have in mind in particular. First, you get excessive clustering around standard loan features. To mitigate to mitigate the conflict, the CLO governing documents limit CLO managers to buying loans that a rating agency has rated, and then cap the fraction of the low-rated loans, like triple Cs, that the manager can hold. These rules mean that a loan's rating matters, not just for what the rating signals about the loan's quality, but for the rating itself. And that fact encourages clustering, as would-be borrowers, who after all want their loans to be attractive to CLO managers, design their contracts with an eye to barely making a particular rating cutoff. It may be worthwhile for a borrower to offer features that the agencies are familiar with and to keep salient metrics like pro forma leverage, interest cost ratios, at levels the agencies have previously validated, even if those terms are in no way expected value maximizing. Second, even with a rating system in place, you should expect loan terms to be excessively risky relative to the Coasean benchmark. Ratings cabin a CLO manager's ability to chase risk and with it returns, but they don't eliminate it because there are many dimensions of the loan contract that the rating agencies don't consider, and openly so. Take, for example, what's known as incremental borrowing capacity. If you're a lender, one thing you care a lot about, something that affects substantially your expected recovery, is the extent to which the borrower can dilute you by issuing more debt ranked equally or even senior to you after you have funded the loan. It's typical for loans to give the borrower some incremental borrowing capacity, but how much is appropriate? Because A, the rating agencies don't account for incremental borrowing capacity, and B, CLO managers will tend to overpay for risk, you should expect more incremental borrowing capacity than the design story predicts. Okay, a second impediment to value maximizing design is a function of the difficulty of knowing what contracts mean. A funny part of many law and economics inspired models of contracting is that they treat meaning as given and obvious. I don't know how we lawyers should feel about that, since our function is largely to translate or develop a correspondence between concrete reality and the language of authority. On one hand, the assumption that parties know what their contracts mean implies that we lawyers are really good at what we do. On the other hand, it suggests we don't really deserve to be paid, or paid much anyway. In any case, the truth is it's hard to know what words mean, at least in the sense of grasping how they might come to matter in the world. And that's the key. The lawyer doesn't only need to know the gist of a clause or the definitions of the words that compose it. She needs to predict how it might interact with other contractual provisions in future states of an as yet to be realized world. And that means, among other things, that when a counterparty proposes an unfamiliar term, there's a risk of adverse selection. Does my counterparty have in mind an interaction effect that I just haven't yet seen? And it's not just what I might understand or not. It's in the future, my client might want to sell the contract. What will its potential buyers think about some non-standard term? Now, happily, my clock is ticking at 6-minute increments as I'm thinking about these questions, but you can see where I'm going. It isn't easy to innovate in a quasi-adversarial environment that requires buy-in from multiple parties, each of whom expects to capture only a tiny fraction of the social benefits of innovation. And any one clause, therefore, faces an uphill battle, even if it's value maximizing. Starting from scratch is off the table. The result, and Marcel Cahan and Mike Klausner made this point in a series of great papers a couple decades ago. The result is commodification and boilerplate. The indefinitely numerous possible transactional forms are reduced to a small number of types: a common stock issuance, a convertible note, an IG bond, a high yield bond, and so on. And most of the terms that constitute each type, at least at the level of architecture or the logic of the deal, are standardized to the point of being essentially not open to negotiation. This undermines parties' ostensible quest to maximize value in two respects. First, in the cross-section, deals of a particular type will be much more similar to one another than would be ideal given the underlying heterogeneity of economic possibilities. Second, in the time series, the terms around which a type of deal clusters will exhibit path dependency. Even if the terms struck long ago were as good as possible, setting aside the clustering issue, we should not expect them to be so today or in the future. The conditions of the world change, but terms of the contracts stay the same, to paraphrase a great movie. For example, bondholders typically need only 25% of the notes outstanding under an indenture to bind everyone in the group. 25%. That's because 100 years ago, it was hard for credit investors to find each other, or for a single investor to accumulate a majority stake. But what's the right threshold today when I can punch a few buttons and a robot car will pick me up from the airport? I don't know, it's not 25%. Finally, the efficacy of design is limited because investors don't in fact know how to price marginal variation in most of the dimensions of a financial contract. And here I'm relying on work that I'm doing with Dave Hoffman. Notwithstanding what I've just said about boilerplate, lots of contract terms vary from deal to deal. Many, but not all, of these are scalar variables. So how many board seats does a venture capitalist get to appoint? When should high vote shares issued in a dual class structure sunset? How much can a company pay out in dividends? In leveraged loan negotiation, which Dave and I studied fairly rigorously, it turns out there are about 100 of these terms. What they have in common is there's either disagreement among market participants about what makes sense, or else, and more commonly, there's agreement that the appropriate value of the term depends conspicuously on deal-specific facts about the company, the investors, or projections about future macroeconomic conditions. If any terms are going to be optimally set, you would think it would be these. Quite apart from discovery through active negotiation, recall that the theory says an issuer, to the extent it gets to design the contract, will set values efficiently, that is in a way expected to maximize its and its investors' joint surplus, because the prospective investors will bid for the contract. The problem is that the investors don't know how to price most of these terms, including terms that everyone can see has a material economic impact, and that they don't even try to price them. In some kinds of transactions, like most M&A deals, price is actually fixed before most of the terms are agreed. It's easy to see that the price mechanism won't work there. But the claim holds even with respect to transactions like most security issuance, in which price is determined in conjunction with or even after the selection of the non-price terms. So this idea has bothered me for a long time, actually for a bunch of years, because it's just so irrational. And I refused to accept it until I spent a lot of time talking to credit investors. Junior analysts on up to on up to investment committee members with long service in the industry. They just don't price most variable terms because it's too hard. The same difficulties of endogenous selection, interaction effects, and statistical power that plague academic econometricians also bind investors. The fact is that most contract terms, even terms that investors consciously believe to matter, are not accounted for at all in investors' pricing models. As a consequence, issuers don't internalize the costs of inefficiently self-favoring terms. Now, this is not to say that nothing disciplines term selection. There must be non-price discipline. Otherwise, companies would issue securities that promise nothing but a claim on cash flows. Now, Hoffman and I argue that the professionals who negotiate one or another type of a deal for a living often create and mutually enforce a normative, argumentative culture grounded in precedent, akin to common law. The principle that like transactions deserve like terms does much of the work to prevent unraveling. To the extent that negotiating parties can sometimes recognize that new macro conditions or an unusual kind of company merit deviation from the range of what had been typical, a system of precedent may resemble a bounded search for more efficient terms. And in that sense, it has a Coasean as well as a common law flavor. But it's a long way from the notion that security pricing leads companies to draft contracts that maximize joint surplus. Okay, that's design. What about selection? Why doesn't competition perfect what design alone can't? I'll keep this short because in a sense it's a lot easier. There's at least three properties I want to say about the selection environment for contract terms, which together leave us far from the conclusion that Alchian's thought experiment took us to. First, there aren't many contractual variants. Selection chooses among available alternatives. In a simple model, we might posit infinite variance. With enough repetitions of a culling process, the best survives. In the real world, there's an indefinitely large number of possible variants, but there are only single-digit thousands of companies, and in part for the reasons I've just outlined, not so many deal types that can be made to compete. Selection won't get you better than the best available. Second, variation in the terms that a company might propound has only a small expected effect on the company's survival. Evolutionary theory has a concept, neutral variation, to describe traits like the appendix that do nothing for an organism's chance of survival and reproduction, but that also don't cost much. Selection against them is weak. Most contract terms, I'll say, are like appendices. If you want to predict a company's growth trajectory over time, you want to know the quality of a business model, maybe the sanctity of its intellectual property, the talent of the personnel, the macroeconomic conditions. The terms of callability of outstanding debt will matter, but only a little. So you would need a lot of generations, so to speak, for inefficient approaches to that problem to be weeded out. Third, economic conditions change too rapidly for a convergence process to select the fittest contract terms. In evolutionary theory, fitness is always relative to an organism's environment. If the environment changes frequently, then traits selected for in one generation might be selected against in the next. You don't get convergence, much less convergence on an optimum measured at any particular time. That's the situation in financial contracting. The contracts play out over multiple years or even a decade or more. Meanwhile, modern capital markets are only, say, 200 years old. And we all know how much accounting, IT, trading, and so on have changed since the railroads were financed. But all those parameters are jointly determining the optimal terms of an investment deal. If financial contracts could produce a payoff, good or bad, within the lifetime of a fruit fly, and if there were as many contracts and companies as there are fruit flies, then you could really imagine selection working. But that's not the situation. In the real world, selection might cull the most profoundly stupid terms, but we really shouldn't expect much more from it than that. Okay, so where does this leave us? I'm afraid I don't have a super satisfying conclusion. It's natural to want to ask how far from the ideal financial contracting is. Everyone knows that nothing in the real world corresponds perfectly to the theory. We all know we don't live in a frictionless vacuum. But how different is the world of capital markets contracting from a Coasean paradise? And the unsatisfying thing about my comments is that I can't answer that. And I can't because I don't think there are any units of measurement. There's no way to even give a ballpark estimate. That said, I have a qualitative conclusion worth saying clearly. One way to imagine frictions in a contracting environment is as a kind of tax on each margin of a deal. You take a notional value maximizing transaction, and then you have actual contracts over here, which are just a little worse in every respect. A little noisier, a little less calibrated than the ideal. I think this is the way that most law and economics influenced scholars implicitly see things. But I think it's not the right mental model of imperfection. The kinds of friction we're discussing here don't necessarily work as taxes on the precision of each dimension of a deal. Instead, together, they yield a world defined by clustering and path dependence, a world in which we should have radical uncertainty about the efficiency of the vast majority of the terms in a typical IPO or bond or loan deal. Well, what of it? Suppose I'm right. What should we make of that? Here I think the answer depends on perspective. As an American citizen, I'm sanguine. Dean Chilton likes to show charts of economic growth in economies around the world. That's on one axis, and it's crossed on other axes by various features of the regnant legal order. Is there a parliamentary or presidential system? Which human and civil rights are enforced, and so forth. My takeaway when he shows these charts is that property rights correspond with economic growth and most other good things, and everything else is noise. From the perspective of civilization, it's fine if activist bond funds have slightly too easy a time extracting green mail from an issuer. The really important issues will get dealt with, and the rest is a rounding error. As lawyers, though, we might think about this differently. Our job is to use words to try to wring the last 0.4% of prospective value out of a deal. That goes arguably for the judges, who sometimes are called on to construe complicated contracts, as much as it does for the lawyers who create and manage complexity in the first instance. The general lesson, I think, is to put more weight on first principles thinking relative to the wisdom of the actual. On the judicial side, for example, you might think that tolerance for unwritten legal principles, principles for interpreting contracts or derogating from them, might depend on the extent to which you think that the term you're construing is the product of a rigorous maximizing process. The more accidental you think the term is, the more, all else equal, you might be willing to impose what seems to you a straightforwardly better rule than that, even if it's in tension with the text. And on the planning side, the lesson is maybe a little subtler. It's not exactly that when you go out into the law world, you should just try to experiment with terms that you think are superior. Almost by definition, what we see in the world is the output of a local equilibrium. The frictions we're talking about are real. It might not be possible to improve your situation or your clients by a willful act of transcendence. Nevertheless, recognizing the degree to which existing terms might diverge from the ideal, and especially why they might diverge, might inspire innovation at a higher level of attack. The lesson is that if you can find ways to erase or avoid a source of friction, you can develop a product or an offering that may generate more value than standard law and economic models would predict. Thank you.